Hello, everyone, and welcome to the Prosperity Through Multifamily Real Estate Investing podcast. So glad you tuned in with us today. We have a phenomenal guest with us joining us today, but you're also very lucky because for the very first time in a very long time, joining me together is the trio, Mr. Brian Alfaro and John Beatty. Gentlemen, good to see you.
It's good to be back together, the three amigos.
I know. Our special guest ain't gonna know what to do. I don't think he's ready, but we'll see what we can take. But
well, Cody, tell everybody the good news.
Well, yes, thank you. So very, very honored and excited, and want to thank all of our tuned in listeners for helping us to reach the number 21 spot, I believe, on FeedSpot's top 70 multifamily real estate podcast for 2021. So very honored to have that recognition. Want to thank all of those who tuned in with us and really have benefited from our content. So keep tuning in. Really appreciate all your guys' support. So, and with that, let's go ahead and pivot. Brian, tell us who we're talking to today.
All right. Today we've got Mr. Mark Hamilton. Mark is a veteran real estate investing expert and founder of Hamilton Zanze, a real estate investment firm with a portfolio of over 4.3 billion with a B that specializes in multifamily investments. The company is one of the nation's largest privately held multifamily syndication companies with over 20,000 apartment units under management. Mark has
20,000.
20,000. Mark has really positioned himself as the expert who has seen ins and outs of multifamily investing. One of the things Mark is really passionate about and expert in is the 1031 exchange program, which can be an interesting topic for us to discuss today. So, Mr. Mark, welcome to the show.
Thank you, gentlemen. I appreciate it.
Yeah, your resume, Mark, is fantastic. When we saw 20,000, we're like, oh, maybe it's a typo, but it's not.
No, it's not. It's actually 22,000 today.
Wow.
So, we grow a little bit every year, and we've worked hard and been fortunate.
Well, let me just tell you, Mark, you look pretty damn good for somebody who's got $4 billion worth of assets under management. I'll just say that. I'm sure you've been through a lot.
Sleep at night.
Yeah.
Let me get my wife in here, and you can repeat that.
we tend to stay more neutral party. We don't want to get involved in any marital relationships. Thank you, though. But hey, man, really honored to have you on the show, man. And I really look forward to learning more about you and your background. And kind of kick us off from there, man. Tell us kind of where your journey started and how you got to have such a large portfolio.
Well, I appreciate that. And I think it's instructive because it didn't start out big. It was very much the opposite end of the spectrum. My wife and I thought I was going to be possibly a writer or have a career in letters or in college teaching or something. And after I got my master's degree, it was clear that wasn't the path. And my wife had followed a dream of having a degree in political science and then working on policy. And she ended up working for her parents' manufacturing business, and I ended up working at a commercial real estate shop. And it didn't take too long before we decided we needed to do something more. And we went out and bought a little duplex in San Francisco that was so rough it made her mother cry when she first saw it. And so that was our first syndication. It was her parents helped us with the down payment. My parents helped us secure the financing. And then we literally sanded floors and sanded the walls and put in cabinets and put in tile and worked our day jobs and then worked this as an evening job and ate peanut butter. And we just kind of got hooked on it. And we ended up doing a few more small transactions in San Francisco with a gentleman who was my boss at the time in the commercial real estate firm. And then another couple that we were very close with also started doing the same thing with family. And one night, I can remember it was December 31st, 1987, when you guys weren't even wee lads. We were having dinner with this other couple, and the gentleman said, I want to propose a toast. Let's all quit our jobs and go into business together. And that's just about as prepared as we were and as formal and analytical as we were. And so we did. And in the late 80s and early 90s, we did a lot of small stuff around San Francisco. Eventually, we all know how expensive San Francisco is. And eventually, even then, even 25 years ago, it had gotten so expensive that you could buy things, but you wouldn't have any cash flow. And we really wanted to have distributable cash flow. So by then the business reorganized a little bit. Our partners went on to do different things. My wife took the management company and I took the investment business, and just continued working San Francisco a little bit, started working Oakland, a few other parts of the Bay Area, and gradually working on bigger things. And then in 2001, I met Tony Zanze, and he had had a long and distinguished career on the institutional side of the business, and my side of the business was always about chasing deals and turning over rocks and dealing with landlord tenant issues and permit issues and one thing or another, just kind of getting deep in the weeds. And he liked what he saw, curiously, and suggested we become partners. And I mean, I knew where he was working at the time. He was working at a gold-plated institution. And I said, the best thing that could happen to you is that I'd say no. How in the world could you think about quitting a job like that? But he was determined to do it. He really wanted to get out of the corporate world and become an entrepreneur. And so Tony and I became partners in 2001. And the first deal, I probably had about 400 units under my belt at that point in time, and he had some also. And the first deal we did together was 16 units. And we had an exchange in there. His father had a 1031 he needed to complete. And we had a lot of friends. Well, we had a small number of friends and family that we were able to put in as co-investors. Back then, our rank and file investor base was probably 2 or 3 dozen people, friends, family, colleagues, and the like. And so we put together an org chart with a partnership and then an exchange investor. And that kind of became the textbook approach for us. We do a lot of 1031s. We don't do only 1031s. We also have funds. We've also done DST executions. We've also done institutional JVs, but probably 2/3 to 3/4 of our business over the years has had at least one exchange involved in it. And typically there'll be multiple. And along the way, and this is really where the success of the business has come. We've secured a lot of really terrific people in the organization. We're just terrifically lucky to have the people we have in the staff, and most of our leadership has been around anywhere from 10 to 16, 17 years. And so we've done a good job at hanging on to people. And it's a culture where people love the work and they love each other. And we get to spend time together, although not so much the last year. But we really, I call the office my wellness center. And I think for a lot of people, they might liken it that way as well. But that's how it's grown from a duplex to a 16-unit building to something more material over 35 years.
Really, really awesome story, Mark. I really appreciate you sharing that. And, it's really inspiring to hear, because I feel like a lot of times there's a disconnect when we talk to people like yourself that have been so successful. You have this absolutely massive portfolio. It's very easy for us who maybe are at a much lower level in our career to understand that you started somewhere, right? You started from zero. It didn't just, like you said, you told us before the show, it didn't happen overnight, and it's even more inspiring to hear that, you were working, your wife was working, you started small, you bought a duplex, but you put in some sweat equity, and then things just kind of organically kind of grew from there. And, it's good to have that reality check, and people understand that, like, listen, everybody starts from a clean slate. Y'all got to put in the work. That's all it takes.
Well, Cody, I appreciate you saying it that way. I do think our growth has been organic, and it's really and truly, this is going to sound very homespun and very Norman Rockwell, but it really has been about just getting out of bed every day and doing the work, having something that you like to do and people that you get to like, that you get to enjoy working with. And then if you can make ends meet, you can stay with it, and staying with it becomes the means of making it work out.
And you stayed with it 35 years.
Yeah.
Those compounds over time significantly.
Yes, it does. Your good friend Warren Buffett would say that, the beauty of compounding interest.
Exactly right. What speaking of the 35 years, we know you've seen maybe an up or down or two. We'd like to
Mhm.
really get some stories and some color on where you've been through the years and some lessons that you might share with us.
I'm happy to do it. And, you guys might be able to relate to this. There's a curious need that we all have, and it's called paying the rent, right? Paying the monthly bills. And so it's scheduled income. Durable income is something that's extremely important for most of us. It comes in the form of W-2 income or salary and bonus. And when you pull up stakes and leave your salary job, as my wife and I both did, there are times when it can turn into a little bit of a white knuckle ride. And oddly, those of us who've been around 20 years remember the long-term capital fiasco. We remember the .com. We remember the Great Recession. And now we're living through another one. And by historical standards, the one that knocked us for a loop was the downturn that followed the Gulf War in '89, and also followed a radical overhaul of the tax rules, and also followed the savings and loan meltdowns. So, we were a small business, just getting by hook and by crook, and by doing small deals and turning them over. And then when the tide went out, we didn't have a whole heck of a lot to do except stare at each other and wonder how we were going to pay the bills. But we ground through that, and that one was the one that for us was most challenging. That was truly the episode of hitting the wall. But you pick yourself back up and you just stay with it. I had a gentleman who also worked in the commercial real estate firm, who I didn't really know that well. But he and I were having a conversation. I just said, I don't know how we're going to get through. And he said, I'll tell you how you're going to get through. You're going to get out of bed every day. You're going to go to your office. You're going to do the work that you can do. At the end of the day, you're going to turn your computer off and go home and forget about it. And you're going to come in the next day and do the same thing. Just kind of put one foot in front of the other. And given that I had no options, it was not only the best advice I got, it was the only advice I got. And I followed it. And, as you get through and things come back to life slowly, as they do in times like these, you guys know that. You get your confidence back and you just keep going to work. So when the long-term capital meltdown happened, my business was different by then. It was moderately more, certainly more evolved than 2 units. I think by that point in time, we probably had 250 to 300 units. Long-term capital didn't affect us at all. And the .com thing, I actually called it completely wrong. I told people not to buy. I had some friends who were looking to buy homes in San Francisco. They asked me what I thought. I said, you'd be crazy to buy a house right now. But interest rates went down and the values went up, right? We all know that. And so in 2008, 2009, Tony and I had grown our shop to about 27 people. And it was tough because it wasn't cash flowing, right? We were able to make, we had some scheduled income, but it was mostly transactional income. And if you live by transactional income and the transactions go away, you've got a problem. So we did some layoffs, and there were some people who were just ready to move on. And we downsized the company from, I'm going to say 26 people to 17. And then that was 13 years ago. And we got to this downturn, and once again, you don't know what you're going to do. But we had actually, by personal mandate, we had accumulated some reserves that we left in the company. So we had a bit of a cushion, and we just decided that we were going to keep the staff. We weren't going to lay anybody off, and we were going to grind through it. And we ended up having a break-even year last year, which we thought we might have fairly significant negative, and we broke even. And I don't know that we're completely out of the woods yet, but we ended up doing about 450 million of acquisitions, which was our third biggest year. So we did have some transactional income, and I think we'll have transactional income again this year. And one of the best things you can do when your bell gets rung is take a deep breath and pause and give yourself the opportunity to just stabilize and then figure out what you need to do. But there are always going to be deals out there. And it's just a question, as you gentlemen know, it's just a question of, what does your capital look like? What are they looking for? Do they want more growth and less income? Do they want more income and less growth? But, again, over 35 years, there's never been well, I guess in the late 80s and early 90s, demand fell apart. But otherwise, in anything remotely resembling a normal time, there's going to be capital. And as we've seen lately, more capital that wants deals. And then it just becomes a question of really doing your homework. And you have to have a clear strategy in your own mind, and then do the underwriting to validate whether or not you want to push play and go on something, because you're going to have your own skin in the game and you're going to have your reputation on the line.
Yeah.
Mark, I think there's something to be said about the message I'm kind of hearing, and correct me if I'm wrong, it's just, there's something that's just staying in the game. You got to stay alive, right?
Mm-hmm.
It's about market cycles. You're going to have your ups where everybody's kind of high-fiving and, everything you look at seems like it turns to gold. And then you have your downsides. And as long as you've been buying right the whole time and you're buying on good fundamentals, which is what you just said here a minute ago, and you stay alive, you just got to wake up every day, do what you did, go to work, and things eventually change. But if you get killed along the way by not sticking to your fundamentals and buying right, that's when you can't live to survive those market cycles.
Well, that's exactly right, Brian. Thank you. And and that's also where it comes in. Your life support is whatever household income you have, whether it's your own, whether it's your spouse's, whether it's a combination. Keeping the lights on, and then having and not taking a psychic beating, and being able to go to work. That's exactly what it's about. It's about not getting too tied up in the highs or the lows, and just really interweaving yourself with the work and the people you work for or work with. And if you can do those things, you're going to have a really good chance to stay in the game, as you just said. And that's where your opportunities are going to come. They're going to come. Every day is going to have a different set of opportunities.
Yeah, I think for any entrepreneur that's getting started, or maybe they're having struggles in their journey, I think this is a really relevant point to make, Mark, because, and this resonates across any sector, doesn't matter if it's real estate or not, but listen, it's hard. I mean, it's a hard career path any way you go, and you're going to get your teeth kicked in. You're going to get kicked in the gut, and it's going to hurt. But, as you mentioned, I think that's what separates, obviously, those who fizzle out of the business and those who make it to that success, whatever that level is just being able to learn from those lessons, grow from those lessons, continue to build on those lessons learned, and keep moving forward, like you said. And so I really appreciate that. So, Fortitude. I love it. We talk a lot about mindset, and we talk a lot about, perseverance. And I think that's what, yes, of course, there's the nuts and bolts of actually building the business as far as the real estate. But I mean, listen, a lot of it's right here too, right between the years.
Well, that's a really good way to put it, Cody and John, because, the other thing you have to do, it's not just about determination and perseverance. You have to keep your spirit up, because ultimately in this business, you're not going to get a single thing done if it doesn't involve doing it with other people. If you're going to find a deal, that deal is going to be brought to you by somebody. If there's a broker involved, it's the broker. If you're direct with the seller, it's the seller. If you're renovating, you got to have good relationships with your tradespeople or your management team. If you're syndicating, you have to have good relationships with investors and with your potential investors. And so, again, our experience has been that it's really beneficial to just really be your own worst enemy on your underwriting, right? To underwrite hard. There are always going to be people who are willing to kid themselves about the returns, or even be nonchalant about the returns. But in the business that you gentlemen are in, the business is providing returns. And so you have to be able to be really tough on your underwriting. But if you do that, and you have your own skin in the game, and you have good relationships with people, you don't have to pledge somebody a 25% IRR and a 12% cash on cash. You don't have to, because ultimately you'll have people who want to work with you because they want to work with you.
That's a perfect segue into the next question I wanted to bring up to you, Mark, is, you started out very early on in your career with syndicating, pulling together resources. Um, how have you seen the syndication model in business evolve over the decades? And right now, especially in the last 10 years, I feel like it's become the hot ticket item, right? It's the one-way ticket to success. But it's interesting because we've been seeing a lot of more creativity in syndication models, equity shares, equity structures, however,
Sure.
tell us a little bit about what you've seen over the course of your career with syndication.
So ours has been, we've never raised money through a broker dealer channel, or paid commissions. The people in our office that do client investment and investor relations, everyone's on salary or bonus, so we don't pay any commissions. We don't, it's hard to do a newfangled thing, right? Because the world's a pretty tough place, and the world isn't necessarily going to like a newfangled thing. So our business over the years has always been growth and income, and sometimes it skews more heavily toward growth, and sometimes it skews more heavily toward income. And what we've seen, with almost no exceptions, is that in institutional JVs, which we've done a few dozen institutional JVs with household names, they want the growth. 9 times out of 10, what they're looking for is a real value add opportunity. You're going to do real heavy lifting. You're going to do real CapEx, and you're going to own it. Well, it used to be 2 to 3 years, but now it's much more like 3 to 5 years. And they want to see, a mid to high teens IRR. And they're more concerned about capital growth than they are about cash on cash in many instances. On the other hand, with what I refer to as rank and file investors, it's people like us and our friends and family and colleagues, right? It's people we know. They tend to want more cash on cash. They want to see distributable income. Of course, they want growth, right? They could all go together and buy a Walgreens or a CVS and get a coupon clipper, but people do want the growth also. And what we've seen is that based on the landscape of apartment offerings, they usually are one or the other. And truthfully, it's harder to find the high IRR, heavy lifting, short-term deal right now because the market is just super efficient. So we've never used a broker dealer. Our funds have always been very small, and when we have something we want to do, we're our own number one investor. So investors know that we have skin in the game. And when I say we, it's me and my wife and her family and mine, my partners and their families, key employees in the shop, and their families. And in the aggregate, we are, as that constituency, we're the biggest investor in the organization. And so people know we're going to get the deal done. And we also stay in very close touch with people so that we know what people are looking for. It's a lot of it's common sense. Is it going to be easier to subscribe something that's going to start out with a 6% cash on cash or a 3%, right? I mean, that kind of math solves itself. And then people just pick and choose. Almost the vast majority of our transactions are one-offs. We've done a few portfolios or small pools, but usually they're one-offs. And so our clients have the opportunity to go thumbs up or thumbs down on anything that they want. And so they're investing not only based on our guidance and conviction, but based on their own sensibility. I mean, you will have people who simply won't invest in Arizona because they think Arizona shouldn't exist, right? You shouldn't have 10 million people living in the middle of the desert and using a lot of water. You might have people who just can't get over the thought of investing in Las Vegas, right? And we give everybody, they have the control panel. They decide what they want to do and what they don't want to do. But I think it comes back to what you gentlemen have put your finger on. It's just about doing the work and coming up with opportunities that you really believe in and are going to commit to, and then putting the word out. And it's a fairly old school approach. But that's how we've done it. We've never advertised. We've never raised money electronically. And, we all use the term friends and family, but our shop is truly a friends and family equity base.
I like that. That's really cool. A lot of strong rooted relationships there. Just out of curiosity, I'd be curious to see at what point in your career or in the evolution of your portfolio did you start introducing those institutional JV partners on some of these deals? What would you say your experience level was? Just curious.
Well, that's a really good question. As we talked about before, I started in '85. So by the time Tony and I became partners, I had 16 years under my belt. I started in the commercial brokerage firm in 1981. So I had 20 years, almost 20 years in the business and 16 years at that point in time as an investor. Tony had great credentials and an equally long career. He had a distinguished career. He ran the West Coast lending office of GE Capital. He was a debt and equity placement agent for Northwest Mutual. He was at REEF, Rosenberg Real Estate Equity Fund, when he and I bumped into each other, and his credentials were very institutional. But I got to confess, I've lost the thread now. I'm yammering so hard I can't remember what your question was.
No, I was just asking, at what point in the evolution of your business,
That's
your
right.
portfolio?
JV, thank you. And so I mentioned that our first deal was 16 units in 2001. By 2004, we bumped into an institution, a New York pension and fund shop. And we had an 85 unit deal in the East Bay of the Bay Area. And with only 3 years under our belt working together, we had our first institutional JV. And that one kind of fizzled and sputtered more than, really took off. But we ended up doing another 6 transactions with that shop in Colorado. And so by I would say the mid 2000s, we had already done more than a half a dozen institutional deals. And, a lot of times if people know what you're doing, people will find you. And, again, we ended up doing, I think we've probably done 30 to 40 institutional JVs and with a significant number of household names.
That's incredible. And to use your example you just mentioned, and I was talking to Brian about this earlier, it's a much smaller example, but we've reached a point in the visibility of our podcast show, for example, where we're no longer having to attract guests, they're coming to us. And it's a really cool spot to be in, when people are seeking you out versus you kind of seeking them out. But it just goes to show that, like you said, if you're out there, if you're building your brand and your reputation, people will find you. And it's a relationship driven business, right? So
and you guys found me on your porch, and weren't you surprised?
Yes.
Yeah.
Well, Mark, let's pivot a little bit, man. You mentioned something earlier. You have a lot of experience in structuring some of your offerings with 1031 exchange, Delaware statutory trust. I'm really curious to kind of get your perspective on that. Obviously with the new administration come in, the big talk was, 1031 is going to be on the table. Sure. Kind of died down really quickly now, it seems like. So maybe a political campaign there, but really curious about the deferred sales trust as well, because I actually coincidentally the day of this recording had a conversation with the DST financial advisor about this. And so we really love to see how you kind of structure some of those deals and how's that's worked out for you.
Well, that's in terms of timing, that's an excellent question for us, because we do a white paper once or twice a year in our office, and we just finished our 3rd white paper, which will drop into public view on March 5. So you can check the website on March 5 for our 1031 paper. And usually it's not really an info. These papers aren't really infomercials per se. They're really more substantive. Our first one was co-authored by CBRE and was about was just the 10 best reasons for investing in multifamily. You probably find that on the web too. The second one we co-authored with Clifton Allen Larson, which is a boutique CPA and wealth management firm nationwide, but our contacts are in Pasadena. And it was 10 tax benefits of owning real estate. So this next paper is 10 reasons that the 1031 exchange is good for the economy, is good for communities, and is good for not only the IRS, but for municipal treasuries. And so it argues it argues more to the public policy aspect of it. And it's, again, it was co-authored by CBRE, and it's scaffolded on a very detailed and extensive research paper called the Ling-Petrova paper. There are two professors, Ling and Petrova, who wrote the paper, the original paper in 2015 or 16, and then it's been updated. But it's really an economic analysis of what the 1031 does for society. And so our paper will address that. But we have two primary strategies that we follow for doing 1031s. Well, actually three. One's a tenant common structure where we might have, generally speaking, we're going to be limited to having 10 entities on title. Once in a while, we'll get 12. Once in a while, we might even get 15. But we're doing long-term debt, 10, 12, and 15-year money with Fannie Mae and Freddie Mac, and we're in the preferred channel with both of the lenders. And then we'll have one or two or three partnerships that go on title and take up one or two or three slots, and then we'll have anywhere from 7 to 9 individual exchangers who are coming in and going into title in a single member entity. It's basically an LLC that they're the sole owner of, and that qualifies for the 1031. And so you have these a variety of entities on title. If we have more than one partnership, it's because we had one or more other partnerships that were also in 1031 exchanges. And that's kind of the tip of the spear. We look at things that we're well aware of exchanges we have to complete, and then we look at things, we turn over rocks to find the best of what we can find. And because of our reputation of success, we're essentially always working with people who also need to complete exchanges. And we just set about the business of turning over rocks. We're in 15 states. We're in 27 metropolitan markets. 30 years ago, it was San Francisco and San Francisco only. 20 years ago, it was San Francisco and Oakland. And by the early 2000s, we knew we had to look in other places to find returns. And Tony wasn't intimidated. I always thought I had to have a steering wheel in my hand to go look at property, but Tony had done this interesting thing. It's called take an airplane to go somewhere. And it never would have occurred to me because I wouldn't have guessed that we could support it. But lo and behold, we figured out how to do it. And our first out-of-state market was Washington State. And then we just gradually went to other places. And every year or two, we'd pick up another 2 or 3 or 4 markets. And so, that's how we go about sourcing inventory. We don't feel we have to be in any market, but that we have to be in markets that we want to be in and where we can find opportunity and really more than just one thing, because having an outpost isn't going to work. So the TIC execution is one form. Another is what we call a separate account. And when we get a family, it's usually a family who has significant dispositions of assets going on. It could be commercial property, it could be other apartment properties, it could be farmland. A lot of times they want to come in and be the only investor along with us. So we also do the separate account. It's essentially, on technical terms, it's essentially a simplified version of the 1031, because we're going to arrange the debt, we're going to do all the due diligence, we're going to coordinate the transaction, we're going to put up the earnest money, and we'll put our skin in the game at the end of the line. And because we're involved, Fannie and Freddie will work on the transaction, whereas they might not otherwise. And then the last one is the DST, the Delaware Statutory Trust. And so we've, for those that aren't familiar with it, if you were simply shown the pieces on a game board, you'd think it was a partnership because it's one entity and many investors inside the entity. But it's a trust, and you're generally going to use lower leverage. We're not an aggressive leverage shop, but on our garden for our Main Street deals, we're going to be 65 to 70% leverage. In a DST, you're going to be 50 to 55% leverage generally. And we were sought out, while we don't rely on the broker channel, we were sought out by Cantor Fitzgerald in New York City to be their apartment partner. And they may use one or two other shops, but we've done a number of deals with them and expect to do more DST business with them this year. And then if our investors want to co-invest, they can. But we would not be, those would be people we know who we run through the drill and run through the protocols to get them into the DST. But then Cantor is going to be selling the DST through their broker network.
Is there one particular model or one that you prefer, like versus, the 1031 and let's say the Tenant Common, for example, versus the DST model? And very limited knowledge here, so I can't speak intelligently enough to it, but my understanding is that maybe a Tenant Common structure may be a little bit more simple than doing a DST structure. Do you have any insight into that?
Well, yeah, I mean, that's actually a good question. And I think it comes down to personal preference and bias. And if you're an investor in the Midwest or on the East Coast and you don't really have a set of contacts or sponsors that you can get in touch with, going to the DST is pretty straightforward because you can go to your financial services person, your financial advisor, your wealth manager, and they know how to find DST offerings. We didn't do them for the longest time until Cantor reached out to us. We've done an execution of our own as well, and on that again, we did not use the broker dealer channel, but it's probably mostly going to be determined by the size, the amount of capital that a person has to place, and the amount of that person's comfort level with a large investor constituency. With the DST, you can really, as an investor, you can really put in almost any amount. And with the Tenant Common structure, it becomes more challenging because we all know that prices are high right now and cap rates are compressed. And for Fannie Mae and Freddie Mac, they're usually only going to want us to have 10 entities on title. So if the sweet spot for the market right now, in our estimation, seems to be kind of 35 million plus. We're just not finding the kind of returns that we want to get on smaller properties. And so if we're doing a $50 million deal and we got to put in a third for equity, you got to raise $15 million in cash. And so we'll always have one or more partnerships in there that do significant part of the heavy lifting, but then your remaining ticket price for the Tenant Common investors tends to be a fairly material number, because you just can't divide 15 million by 10 and end up with small numbers.
And the other consideration there too, as well, as you need to be making sure that you're working with vendors, lenders. I'm assuming accountants and attorneys that are familiar with these structures as well, right? Because there are some implications, especially from the debt side, in working with these particular trusts and 1031 exchanges, correct?
You bet. The financing has to be arranged correctly. Very often people who come in who sell a property will own it free and clear. But if you're selling a property that has financing on it, you have to replace the financing in order to meet the 1031 rules. You have to invest all or more of your equity in real estate costs, and you have to secure all or more than the financing that you relinquished to take care of it. And I think it's probably the case that bigger investors may favor a Tenant Common approach somewhat more. These are people who've been in real estate for decades, many of them, and they like hearing the story and they like seeing what's going on. Whereas a DST investor may just be ready to just be completely done with it, and mostly what they want is to not pay taxes right now. They want to defer the taxes, and so I do think it comes down to sensibility, but it also comes down to the size of the equity investment that they need to make.
Hey, Mark, candid question. On your next $50 million deal, can John, Brian, and myself jump in? I mean, look, we can mop. I mean, we can scrub windows. We can do something, man.
I'll make sure you have my cell phone number. I'm going to write it down and hold it up to the camera here.
Love it.
But it sometimes does take that, back in the day, we rolled up our sleeves and got dirty, got into all the nasty stuff of dealing with, fiberglass insulation and old pipes and crawling around in basements. And I think you guys are probably too civilized for that and don't quite have to do that right now.
Don't let the looks fool you.
Well, Mark, it's really interesting. Obviously, this relationship-driven business, we're always out networking and expanding our databases and always trying to find ways to partner. It's kind of, this may sound kind of funny, but we really don't hear a lot about guys like yourself, with your experience level. You don't really see you guys out and about too much at these networking events. And, it's kind of curious. And I know there's probably many others like you at the level of success that you've had. What are you guys doing in your spare time to kind of grow your network and grow your businesses?
Well, yeah, I appreciate the question. And I will say, I love hanging out and talking shop with guys like you guys or other people that I get an opportunity to visit with. That's the kind of networking I want to do. I go to a conference every once in a while, less so now. We go to the National Multifamily Housing Councils and to some of the securities conferences and the like. But mostly we're gonna make sure that we're spending quality time with other colleagues that we simply enjoy and love hanging out with. And my partner, our third partner, Kurt Howcooper, who came in a little bit after we founded the organization. He's a terrific golfer. And he's finally decided that he needs this thing called at least a little bit of a personal life. And so, during the pandemic, every so often he's been able to get out and play golf, and he scored a 75 recently. I don't think I've ever been broken 100. And what I do on a golf course is not called golf.
You and I would make great golf buddies then.
We can just ride around in the cart. And then my other partner, Tony Zanze, does a lot of different things. He really likes riding his bike and skiing, loves fly fishing, and is actually up in Idaho as we speak. It's probably not quite fly fishing season, but he goes up there every so often. And it's probably just pretty basic, just like anybody else. It's friends and family and getting out in the world and doing things that give you some enjoyment.
That's great, man. I love that. I think that's awesome. And, just really cool to get that perspective. And, again, I'm glad you're at the point in your life and your business where you're probably hopefully enjoying more of that time now, with your family and colleagues that are close to you. So.
Well, it's true. My wife finally retired after she ran her own management business, most of it with a partner, for more than 35 years. And, management, you got to be willing to do the work to be in real estate, and you really got to be willing to do the work to be in management, because, it's a activity intensive business. And one thing I've come to say about apartments is that it's a strength in business. It's a strength in numbers business, and it's also a pain in numbers business. The strength is that if you have 300 units and you have 10 vacant units, that's not that big a deal, right? You might even have 15 or 20 vacant units, and that's not that big a deal. With apartments, you're gonna turn over anywhere from 40 to 60% of your units in any given year. And so, as long as you meet the market and take good care of your real estate, you're going to be able to handle it. But the pain in numbers is there's always so much stuff to do. And so, mostly how you're gonna solve that is by running with great people, because you guys are not going to be able to be out there taking the midnight calls and and showing apartments and running the credit reports. But we did there. It is a truth-telling business. It will tell you the truth. And if you do the work and meet the market, you're going to be able to go through the downtimes, and then you're going to be rewarded when there's more economic strength and things are rising.
I like that, guys. What do y'all think? This real estate market it's a truth telling market. I really like that, or truth
Yeah,
telling
I'm
business
going to take
rather.
that. That's a
It'll
new phrase
tell
I'm
you
going
the
to use
truth.
now.
It will never lie to you. And you may not like the truth, but it's telling you the truth.
That might have to be the lead thumbnail when we get ready to get this
Yeah,
episode
there you
out. I
go.
don't know what you guys think.
Like that.
Well, John, Brian, you guys have anything else for Mark?
No, I mean, this has been a
Mark-
fantastic conversation. You know, the big thing I think that's really stuck with me, besides all the nuances and the detail that Mark was so generous to share, was you gotta like what you do. You know, you called your
Yes.
office earlier your wellness center. You know, a lot of people get into real estate, you know, to leave their W-2, or they think they're going to sail off in the sunset when they buy a couple of assets, a couple of apartments. But at the end of the day, this is a lot of work. And if you don't
Yes.
enjoy what you do every single day, whether you're planning on doing it for 5 years, 10 years, 30 years, you're not going to have a good time, and you're not going to find a lot of success, and you're not going to be able to ride those cycles that we talked about throughout the journey. So I appreciate you sharing that message. It's just definitely reassuring that, you know, I know I like what I do. I know John and Cody, we're really passionate about, you know, obviously finding our success, but helping investors, improving communities, things like that. And that's what gets us going every day.
Well, and to something that you guys said earlier, right? We were talking about underwriting earlier, and making sure that you're not being too wishful with your underwriting. You know, a property is not going to hand you its own handbook and say, here's what you need to know about this property. You know, we call it due diligence, but it's also about fact finding, and it's about looking for mysteries where you may not see one. But if you really, you know, again, just to coming back to that idea about the truth, if you let the property tell you the truth, and you guys are lucky because you're partners, right? And you have good sounding boards. Each one of you has 2 sounding boards, probably more. You'll know if you'll know if you're going to be able to do something that's going to work if you allow it to tell you the truth, and that's where your rewards are going to come from. You know, if you're too fantastical about your expectations, it may not be a great thing. But if you look for the dirt under the fingernails and all the rest of it, and you still like the deal, then you're onto something.
Very cool, Mark. Really appreciate that insight, and definitely great words of wisdom. So I know that's something that we absolutely take to heart in our underwriting and our day-to-day as well. So, but Mark, as Brian mentioned, man, this has been a great conversation. Really, really appreciate your time. Really enjoyed talking to you. And just, I don't know, man, I feel like I just want to go hang out with you on your porch, have a glass of scotch,
Yeah.
and just, you know, talk more business.
Well, you pour the drinks, and I'll come back on your porch anytime.
There we go.
Done. So, well, listen, Mark, before we go, man, I got 4 more questions for you, and then we'll kind of wrap up. And but you know, what are you doing for your continued education to kind of further your own investing?
Good question. You know, so I'm a licensed real estate broker in California. I haven't done any brokerage this will be 17 years since my last brokerage deal. And I did some brokerage in 2004, and I think I brokered one deal in 2000. And, you know, my brokerage career has really gone by the wayside, which is fine. I mean, I was doing that mostly so I could stay with this. I mean, this is my true love, and I like brokerage too. And but this was always really the catnip for me. And so, you know, I have to do all the real estate continuing education. And then what I would say, and after that, there's really nothing formal. But as I mentioned, we do white papers from time to time. We have a lot of really smart people in the office, including 6 CPAs and 2 attorneys. And our conversations, whether we're talking on Monday morning about our transactions pipeline, or we've got an investment committee meeting where we're going to make a decision about buying, selling, or refinancing a property. Tomorrow afternoon, I have my twice monthly risk call. I would say most of my continuing education in any event really comes from being in it waist deep, and being in it every day. And, you know, as I said, it's kind of my wellness center, or my playground. So it's not a painful way to learn. And, you know, we have a shop with a lot of really smart people who who give their points of view very often in these meetings.
Well, you mentioned there just a second ago about kind of getting waist deep and learning from those experiences. What have been some of those lasting lessons that you've learned along your journey?
Well, I mentioned the one from this fellow who basically just said, you just need to go to work, right? Go to work every day. Don't get too much in your head about it. Put your feet on the floor every day, go to the office, do the work, shut it down, go back and do the next day, do the same thing the next day. And that was probably the most, and it came from a very unlikely place. It was from a gentleman I didn't know all that well. And why he decided to give me this kindness of this great but gentle advice, it just happened. It was pennies from heaven. But the other thing is that you have to be willing to really pound on your deals. And we were talking about this earlier, that you just have to be ruthless in your underwriting. Because if you kid yourself, you'll find out later. And at that point in time, you'll own the property. But the same thing applies to your due diligence. You have to really go out and turn over the rocks. And when we acquire a property, we will go through. We have an inspector that I've worked with for 33 years. And he's done, I will say 98 or 99% of our inspections during that 30 years. And he'll go through every unit. He's an architect and he has some other credentials as well. He'll go through every unit. And then our management team comes in and goes through every unit. And then the lender wants to see a property condition assessment, also known as a PCA report. And so we'll go into some more units for them. But by then by the time we're removing contingencies, we've been through every unit twice or maybe even 3 times. And then you have to do all the other homework, right? You have to do the geotech and you have to do the environmental and you have to do the surveys, and you can't be afraid of doing the hard work. And there really aren't any ways to cut corners. So, you have a checklist, you start at the top of the checklist and work your way down. And it will take you, depending on the size of the asset, it will take you a few weeks. And then you're into the lending part of it, right? And interest rates are going to move around and spreads are going to move around. And so you just have to stay on it. But I would really say that for me, it comes back to the 2 things: just liking your work and going to it and doing your work every day, and not being in too much of a hurry, making sure that that you're going to do every single thing you need to do. And when you have challenges, you got to embrace the challenges, right? If we have something that's a concern, we report to our investors, and every one of our groups is a one-off investor group. So, we correspond with them multiple times a year. We have programmatic communication that goes out, but we also have things that come up that we have to report on. And I'll tell you a little story. One of our early JV partners, had the good fortune to be able to work with my partner, Tony Zanze, for the asset management. And Tony was really good at it and had the credentials for it, right? He went to Wisconsin and got his MBA, and then spent many years in the institutional world, just doing all the detail work. But it got to a point where there was tension between him and this partner, and they asked me to step in. And once again, I said, be careful what you wish for, because you're going to get it. But what I decided to do, and we were meeting with them once a week, which is a lot. We were doing a conference call once a week on the assets, and I just decided I was going to start out with the bad news. Every call, every property we were reporting on, I was going to start out with the bad news. And if there wasn't any bad news, I'd make some up. I just made sure that I was indexing it right to the downs. And then we would move on to what's tracking in line, and then we would move on to where the good news is. And it ended up working really well, and we made a lot of money with these people for pension funds and for ourselves. But just swallowing, I think Carl Jung once said, you start every morning by swallowing a frog, you're going to be okay. And you just can't be afraid of the bad news.
I love that. Well, Mark, man, what advice would you give to the listeners to help them grow their business?
Look for people to have great conversations with. Look for people to work with who can take you to see real estate, right? Go out and kick the tires, and look to form relationships. That's what it's going to be about. You know, we get calls from people who seem to think that you can buy an apartment building and get a 25 IRR and a 12% cash on cash. And, you know, we just tell them we can't do that, right? That's not there. We can tell you what we can do, and we can tell you why our costs are low, that we run very efficiently and our fees are low. But at the end of the day, would we love to do those deals? Of course we would. Are they there? They're not. And you know, I think if people have an opportunity to spend time with others, other real estate people, and have good conversations, and go out and see the real estate, you do those three things, you're gonna go a long way toward figuring out if it works for you, if it's going to work for you or not. And I just don't think you can be in a rush. It's a ground game. And I think for an investor, just as it is for us, you get up every day and have the conversations.
Great advice, Mark. Really, really appreciate that. Tell the listeners how they get a hold of you, Mark, and learn more about you.
Well, so we have a really good website, hamiltonzanze.com, tells the story very well. It's very user-friendly. It is not sales oriented at all. In fact, I don't think you'll see anything on there about invest here. But it's a good website. And I mean, if anybody wants to, they can email me also. And that goes for you gentlemen as well. And it's Mark, M-A-R-K, at Hamilton, Hamilton, Z as in zebra, A, N as in Nancy, Z as in zebra, E as in Edward.com.
Awesome. Well, we'll definitely make sure that's in the show notes, Mark, so that the viewers can go back and reference that. But again, thank you so much for all the great insights and great conversation. And we definitely look forward to staying connected. So thank you so much for tuning in.
Well, I'm
Thanks,
really
Mark.
excited for you guys, and I'm grateful to have been a guest, and I hope we have a chance to talk again. But I do, you know, there's a good life there. There's a good life for you, and you can keep body and soul together. You can just keep doing the work, and that's where it's going to come from.
Great
Awesome.
advice.
Thanks, Mike.
Thank you.
Thanks, Mark.
All right, gentlemen. Thank you.